And nice to see. I'm going to say, okay, you can record me. There we go.
Sorry.
That's okay. And I'll just start again. There we go. So nice to see a few familiar names. So hello, those I know, and hello, those I don't know. I run a niche practice called Calyx Valuations in Toronto. It focuses on, what I call the planning work, the not in the fallout work, I guess is a way to describe it. So, and we get involved in more than matrimonial. We do a lot of valuations for planning purposes and shareholdings, tax purposes, and then disputes, damages, shareholder disputes, financial reporting, transactions. So we're pretty much of a full service firm specializing in the valuations, forensic accounting, corporate finance, and some M&A advisory work. But family law is a pretty significant portion of the work we do. So when Linda said you've got an hour and a half, something close to an hour and a half, including questions, that scared me a little bit because I thought one topic or a couple of topics, we'll see. So I've thrown in a bunch of other topics in here, and that's typically what I do. I add a bunch of other stuff, and I probably won't get to it, but it is there just out of interest. And a couple of things that I do want to touch on are things that are sort of top of mind on issues. So what we're going to cover is some value definitions. I'm just going to introduce the value definitions so that it feeds into the issues of trust and how that on a marriage contracts. And gifting also has an effect in relation to trust as well. So it's a side issue that I'll talk a little bit about. And I may, assuming we've got time, talk a little bit about contingent disposition costs, because I seem to be facing that issue quite a bit. And I think the thinking on that issue has evolved a little bit since in the last number of years. Also with attribution of pre-tax corporate income, which is an income issue. Talk a little bit about drawing on capital or shareholder loans. It's always an issue, but during COVID, I saw a lot of that where for survival, and some of it was just a very temporary thing, and to pay the support orders, either the orders or what it had been agreed to, the payors were having to draw out capital from their businesses and other sources to be able to pay. And I've got a lot of clients right now that are going through the trying to material change or whatever under their separation agreements or their orders to try to change the support amounts they're paying. And in the back of my mind, every time I hear from a client about that, I say, by the time you get to either to court or to mediation or an arbitration, who knows, your business may be back up to what it was, and it may become a bit of a moot issue. And I had someone call me yesterday, unfortunately, that the issue that they're talking about is maybe $700 or $800 a month, and to go through the legal costs and the valuator costs and all the professional fees to try to reduce your support by $800 a month is tough. I mean, the payback on that is a challenge. So I think with some of these cases where they're relooking at support, there has to be a modicum of reality and that cost benefit analysis. And we'll talk a little bit about scenario analysis as well. So first of all, again, when Linda asked me to talk about trust, I thought, I'm not a lawyer, so I have to be very careful here. And there are some cases I'm referring to, and my interpretation or reference to the cases are from a simple valuator accountant point of view. There's probably a lot of other nuances that a lawyer would pick up on, and I may not. And there are probably a lot of other cases as well. And the issue of trust is it's ultimately a legal issue. And I mentioned that we're going to talk a little bit about scenario analysis. And often when I'm getting into that scenario, whether it's hot tubbing with another expert or just me preparing a report and there's a trust involved, it may come down to a legal issue. Should this be attributable, the income or the assets be attributable 100%, 50%, partially to this individual, and both income and assets. So let's do a few scenarios, because it may ultimately come down to a legal determination. And I can help out by saying, here's a bunch of possible interpretations. Let's try to narrow it down a little bit to what's reasonable. But under interpretation A, here's what the income or the value of the businesses would be. B, C, and then you kind of let the lawyers argue about the legal merits of it, and then presumably the judge picks one and says, here's the one I like. The valuators have already agreed to that, or the valuator already gave me all these scenarios. Perfect, we'll go with that. So I think that in general, scenario analysis has been evolving quite a bit, or is used a lot more to recognize that a lot of the issues that come up are not clear-cut issues. And even if you may have seen experts in the past put in an assumption, or you used to see, thank God we don't see this very often, but there would be, we have been asked by lawyer so-and-so to assume that. And that's dangerous, both from, I guess, a credibility of the expert, but also from how helpful are you being to the court, who's ultimately and the parties, they're ultimately our clients. If you're only saying there's only one narrow interpretation, or I don't know what the legal side of it, but I'm going to go with this scenario because the lawyer told me to do this. So I think there's sort of acceptance that may not be very good practice. Not that the lawyers will stop trying to get the experts to do one scenario only. And of course, there's always more slides. There are always more slides in my presentation than we will ever go through. But that's just to make sure. I would hate to end 1 minute early. Now, if you guys have any questions, feel free to ask me. Just come off mute and ask me, because I always find it's much more interesting hearing your questions or your thoughts as opposed to listening to me as the talking head blabber on. I'm going to introduce a few concepts to get us into the trust side. So valuators can come in, and you can call them valuators of assets, or valuators of income. It doesn't matter. I'll just use that term generally. So we can get involved in a lot of the income and the asset, but then we might get into more forensic or more detailed analysis or more reasonability checks. And that's one of the slides I have towards the end. Is what I've sort of come to realize is that sometimes just looking at the statements and using the child support guidelines, using the case law, your interpretation of it, using whatever, doesn't tell the whole story as to someone's income. And you may have to go around it and look at things like, the lifestyle analysis and how is this person surviving. And I actually have that right now, where just a client that recently came to me has, just before COVID, there was a determination on the income. And I'm not sure how they got there, but the other valuator did 5 years, 17, 18, 19, 20, 5 years. But then they ended up just with the last report was 18, 19, 20. And it was partway during the year. So it was just early on in the year. And 1 year was about, let's say, 350, another of income for support. The next year was 19 was like 1.4 million or some crazy amount. And then the 2020 was like 400. For whatever reason, everybody agreed to average those 3 years. I don't know what went on, but now I'm looking at 2020, the actual 20 and actual 21, and there's a huge losses in both years. So initially my brain's going, well, hold on a second. How can you rationalize that in 2 years there was a loss of $1 million? I mean, some of it's amortization, but not very much. So it's a pretty well known, it's a cash loss. So I know already I'm going to have to go around and explain how were the holes plugged. Was it a drawing on capital? Did someone give money, get loan money, the draw on debt, like increased other debt? But there's got to be some reality to it, because I know anyone looking at it at the other side is going to say, well, hold on, how can you have losses for 2 years and still be running a business? How does that make any sense? So in terms of just a reminder of value terms, and this is going to feed into the issue of valuing trusts or trust interests. So the Ontario Family Law Act and other family laws around the provinces don't use a specific term. They use value, and that isn't defined, but probably you can loosely assume it's going to be equitable value. And whatever is equitable, that's up to a court to decide. I don't know. As a valuator, I don't have a term. I don't have a term in my dictionary that says equitable value. So valuators, when they're looking at value, they will generally use the term that we are most comfortable with, which comes out of the Tax Act, fair market value. And that assumes certain assumptions we'll go through briefly, but in general, it's not, not value to owner, but sometimes you'll see some of the cases it actually is a value to owner. And a good example of that is, of course, stock options. That employee stock options are usually restricted to that person. You can't sell them, transfer. Maybe you can transfer them to holdco, but that's typically it. So if you took a strict definition reading of the value to be fair market value, someone would say 0 because I can't transfer it. Nobody will pay me for it. But then we kind of default, because we get this value term, we can default to something other than like a real transactional value, right? Because that's the way valuation started. It was a transactional value. It was usually a hypothetical transaction value, but it was what two parties would transact at. But if you've got this limitation that you can't transfer an asset, then how can it have fair market value? And a trust, so if you think about a trust interest, it's kind of similar. If I'm a discretionary trustee in a family trust, there's who the heck is going to buy that? So we often are using a different value reference point. Valued owner, we talked about already. Oh, sorry. Okay, so of course, the other thing is you always have to find out if there's a marriage contract or a cohab contract, because if there is, and assuming that it is properly written and it would hold up in court, then that would override all or part of the important premises or provisions of the Family Law Act. Now, there's been a lot of case law that deals with whether a marriage contract or cohab contract is enforceable. Okay, so, and just a bit of background, marriage contracts, they don't have to be entered into before marriage. We always think that, but they don't have to. I've had some where they start the process before, and then I had one not that long ago where they wanted to go on a honeymoon, and they didn't get their house in order, and they didn't want to ruin the honeymoon or anything. So they said, you know what, we're gonna get married, go on the honeymoon, and then we're gonna come back and get this contract in place. And it was like, well, look, you always assume it has to be done beforehand, but it doesn't. It can be done in the middle of a marriage, towards the end of a marriage, in case it doesn't break down. And of course, cohabs cover, the common law, for example, if you're not necessarily married. So there's been a bunch of cases testing whether cohab and marriage contracts are enforceable. And it comes down to, and again, it's outside the valuator's purview. It's really, does the contract or the agreement meet the terms of basic contract law? And that's what they tested against. And there was a case in Ontario in 2008 that's sort of considered to be the leading case, Levan. And that was one of the it challenged the marriage contract. What happened in this case is that the husband failed to disclose certain things and certain assets and wasn't disclosing all of his tax returns. The wife didn't get independent or effective legal advice. And the wife didn't understand the nature. That was sort of the conclusion. She was saying, I didn't understand what I was signing. I didn't understand what I was getting into. And the court found that the husband misrepresented the nature and terms of the agreement and didn't properly disclose. So, and he also interfered with the wife getting proper independent legal advice. So if you think about, if you go back and if you've ever taken a course in Law 101 for accountants or advisors, they talk about basic principles of proper contracts to be enforceable. And that's sort of that's been around for hundreds of years, those terms. So this is a great little case and many references to it. So one of the things under marriage contracts, cohabs, you have to have full disclosure. Now, what does that mean? So it means that you can't leave out the fact that you have these businesses or these real estates and only selectively disclose. You have to disclose documents so that the other party who's signing it can review it and get comfortable with it. Seek professional advice, and legal advice, and also maybe accounting or other advice, valuation advice, whatever it is, just to get comfortable. So in other words, do your diligence. And the interest, once Levan came out, what ended up happening quite a bit was going to valuators for some kind of valuation to give to the other party who's going to sign the marriage contract, to basically say, I'm not just going to throw you financial statements and tax returns and whatever else. I'm going to give you a valuation that was done by a valuator. So, if you sign this contract, you're giving up a share of $10 million. I mean, obviously, when you go into it, there's a marriage date credit, but any future growth on that, and maybe even the income that's being generated by that. But the whole idea is, before someone can sign an agreement, they have to know what they're signing off. If they're giving up rights to potentially to an asset or income in the future, they need to know what they're getting into. And lots of cases have overturned the validity of some or all of a marriage contract for various reasons. One is lack of disclosure. Another is, of course, duress down here. That's a common one. The husband came to me, or husband-to-be came to me the night before the wedding or the morning of the wedding, and I was trying on my wedding dress and said, you sign it. Or the father came in. If you don't sign it, the wedding's being canceled. And it was like, I had to sign it because what was I going to tell all the guests? So, the duress thing happens all the time. But it also happens the other way too. I had a client years ago that it was just an awful situation. He basically lost most of his assets that he had built over the years. He had gotten someone pregnant, decided he was going to do the right thing, married her, and she also had another child or two and sort of adopted those kids. And he tried to get her to sign a marriage contract before, and she went crazy. She went totally nuts, and he just backed off and walked away from it. And then it became one of the worst separations I've ever seen in divorces. It was just expensive, messy, and didn't need to happen if he had kind of said, okay, I'm going to hold my ground and make sure that we deal with this agreement. So another, McCain, you probably heard about McCain, that there was a marriage contract, and the wife went to court and was successful in saying that should be overturned. And there was a spousal support release in the marriage contract. And she ended up getting $175,000 per month on an interim basis, which was the largest ever award on an interim basis. I had one years ago that I thought was the largest award, but it wasn't $175,000 a month. So some kind of, and everyone has a different interpretation under Levan as to what's required. So you need should see a lawyer to say, what do you think? What do I need to do a valuation? What documents do I need to disclose? How long, when should I start the process, etc. The one that I mentioned that they decided because there wasn't enough lead time for the lawyers to get everything done and everybody to review everything, and so they decided to continue on with their wedding plans and their going away for their honeymoon. I heard afterwards that when they came back and within a couple months they had signed, the agreement was signed and there's no problem. So it would be very tough for that spouse to come back and say that there was some duress in that situation. So what things are subject to equalization for family law purposes? I mean, basically it's all property owned by the spouses except certain things like inheritance, gifts during the marriage, and accumulated income from those gifts if the donor states that. But it may or may not be excluded from income for support purposes. But so there's some gray area there. Personal injury awards, life insurance policies, and anything that's agreed to be excluded by a domestic contract, what I'm calling cohab or marriage contracts. But of course, those assets have to be kept separate from other property to be excludable. So if you start commingling it, putting a joint account or buy a house together, or another property together, then it might lose some of that exclusion. So what is property? It is fairly broad. It can be a whole bunch of things. Real property, personal property, rights to something, some assets, or rights to income. But it generally, some US states, professional licenses like FDS or whatever the designations, the FDS you guys have, might be considered to property in some states. In some states, no. But in Canada, we don't consider a designation or a license to be a property. But income we earned is considered in the spouse, in the income for support purposes, child and spousal. So just a slide here on the basics of the fair market value. So the basic term we use, what most valuators default to for most assets, but sometimes we have to say, well, we're actually kind of using a valued owner, like the stock options I mentioned, or maybe even a trust interest. So it imposes these unreasonable, well, not unreasonable, there imposes certain theoretical conditions of the market, of a hypothetical market, that are not realistic in any actual transaction. I'm involved in M&A transactions all the time, and I do a lot of research on them to help support valuations. And I don't think I've ever seen a transaction that would qualify to have been done under the fair market value tenets. So some of the brief components, it's the highest price, and although that is sort of been muted a little bit because financial reporting, which is a totally different purpose, but if you're doing a valuation for financial reporting purposes, we talk about it in terms of market participants. So it's not, the highest price, it could be anyone in the universe, right? But I think that becomes a little more realistic. Who are the most logical purchasers? It's an open and unrestricted market. So again, like the stock options, it can be sold to someone else, or the benefits can be somehow transferred to someone else, and they're not legally, and they're not concerned about not obtaining those benefits. It's between hypothetical, willing, and able parties. Both parties have reasonable knowledge of the underlying facts. And so they've done their diligence effectively, or appropriate diligence. It's done at arm's length. No one's forced to either sell or to buy. So they'll transact if everything works out, and if they come to a mutually agreeable deal, then it'll happen. Otherwise, it won't. And it's in terms of cash, so dollars. So someone's writing a check, regardless of where they got the money from, they're writing a check on the closing date. You get into more different challenges if you've got a situation with the spouses or shareholders. And this is just something to watch in the planning, or when you guys see these situations where the spouses are both business owners, and it doesn't matter whether they're active or not. If they're shareholders, they have rights as a shareholder. So you may get into both a family law matter and a civil matter. And if they're both, let's say they're both equal shareholders, I often have to remind lawyers that, maybe you don't have to worry about a valuation date, like a separation date. In Ontario and provinces that follow that, you may not have to worry about valuing it on the date of equalization, because 50-50 means nobody pays anyone, but you're still left with a 50-50 shareholding after equalization. So if that's the situation, then you may have to be looking to whether they have a shareholders agreement. And unfortunately, most times they don't, because the presumption of going into whether joint ownership, whether it's income splitting or for whatever purpose, is not usually that you're going to eventually separate. So the tax planners, the very smart tax planners, often don't think ahead like that, and they don't necessarily put together a holistic team to deal with, well, what if there is a breakdown? What's going to happen here? So you may be into, and I had a case that went on for years where it was, unfortunately, it wasn't equal shareholdings. So it ended up with both a separation date, valuation issues, and a current date. And it was like 10 years after they still hadn't resolved it. So there was a shareholder oppression action in the commercial court, and then a family law act matter as well. So needless to say, the fees were insane, and the delays, and it was just not a good situation. So if there is ever, if you're ever seeing your clients that have the joint ownership, then have a shareholders agreement. It's marriage contract is like a shareholders agreement for marriages, and vice versa. And it's just prudent practice. So if it is a joint ownership situation, then you probably have to look into that shareholders agreement, if there is one, to see what are the triggers, if any, for buyouts, and how is it to be determined? Either is there a formula, or do you have to bring an evaluator to determine it, for example? And then, of course, if you can't get it resolved under the shareholders agreement, or there isn't one, then your only remedy may be to start an oppression remedy or appraisal remedy, but you have to prove that you've been oppressed, and that A is costly, and B is you're not guaranteed to be successful in that situation.
Could you just explain that, though? What do you mean by oppression?
Oh, okay. So under the federal, the Canada Business Corporations Act, and all the provincial Corporations Act, they brought in the early 70s these provisions that were for minority protections, minority shareholder protections. So the idea was you could, if you had 10% or 5% or 20%, and the majority shareholder was taking money out of the company, was declaring dividends themselves, running personal stuff through, or whatever was going on, you could apply to the court to say, I'm being oppressed, and there's a whole bunch of remedies, and one of them is to be bought out at what's called fair value. And again, an undefined term in the Business Corporations Act, but there's a bunch of case law that came in the 70s and subsequently to define that. And that's basically, a fair price, but not considering any discounts and such like. So, sometimes we have to get into, that case I told you about that just settled finally I think in January, finally settled both the family law and the commercial. And the interesting thing about that was maybe I don't understand the law well enough, but from a practical point of view, I said, can't you just fuse these, bring the family law and the commercial together and just deal with them on one time. But no, they couldn't. They were, they had to keep them separate. They had separate legal teams, one for the commercial side and one for the family law side. And it was just, it wasn't like a Herjavec case where maybe the fees make sense. It was crazy. But sometimes that's the last ditch resort, because if you have joint ownership, there's no shareholders agreement. That means there's no obligation for either let's say one of the spouse who is a shareholder is actually active in the business and running it. There's no obligation for that shareholder to buy out the other shareholder. And there's no obligation for the one that isn't involved in the business to sell out, even if the other shareholder wants to buy. So you get this situation where, I don't have to ever buy you out. So I never have to pay you if it's 50-50, I don't have to pay you any equalization, and I'm never going to buy out your shares. So you can't go and buy a new house because I'm never going to give you money. And then you've got the other side where it says, well, I don't really need money. I got enough wherever they got. I still want to keep my hands like close to this person and drive them insane and require that they send me financial statements every year, invite me to shareholders meetings. And of course, they never had shareholders meetings before. So it could be a very, very bad situation. Okay, so talking about trust. Oops. Oh, what is a trust? It says continue, but it's supposed to be the first slide. So talking now about trust, and that sort of introduction was to start talking about, how do you value? We'll get to valuing a trust interest. So what is a trust interest? Well, it's not a legal entity. It's not a person. It doesn't own property on its own. It just holds it on behalf of others. So it's really a relationship where one or more people or the trustees are sort of operating this property and that they have control over on behalf of others. So the trust agreement, I'm assuming everyone's seen a trust agreement before, but it usually says, who settled it. So somebody has to settle with a gold coin or whatever it is to set it up so it exists. And then the trust agreement, which is really important if you're ever looking at the evaluation or income issues coming out of a trust, is what are those, what can the trustee do? Who are the beneficiaries? Like all the very important constituting factors of a trust itself needs to be looked at. And there's lots of different ways to set up a trust. And just a reminder, I'm not a lawyer, but there are a whole bunch of different ways. So you can have the discretionary trust. So, and discretionary simply means it's at the whim of the person who's controlling it, the trustee effectively. So if I have a discretionary interest in a trust, I may never see anything. If the trustee doesn't, or trustees, the group could be more than one trustee, if that controlling group decides I don't deserve it because, I'm the child who is in and out of rehab all the time and can't, we don't want to give money to that person because we know where it'll go. So if I'm discretionary, I may never see any money. And I have no right to get any money because it's discretionary. It's up to someone else's, it's someone else's call as to whether I get anything. So the discretionary, and it can be even more refined. It can be discretionary as to income of the trust. It can be discretionary as to capital of the trust. It can be discretionary as to both. So I get a regular amount of income, so it's non-discretionary, but the capital, it's discretionary. And so if I get 10,000 a year and I one day say, you know what, I really need more money because I want to go and buy a house, or I want to go on vacation, I can go to the trustee and say, oh, can you please give me some more money? But they'll say, well, no, you have no right to the capital. I mean, they might say yes, but they don't have to say it. So discretionary, in traditional trust law, and again, speaking as a non-lawyer, it's not a property interest. So trust and estate lawyers will say, I don't understand this family law. It makes no sense. Why does family law treat a trust interest as an asset? Because in trust law, no, it's a nothing. There's no certainty. You'll see this on another slide. It's a mere hope that one day you'll get something, and you may never get anything, or you may get a whole bunch, but it's a mere hope. Discretionary beneficiaries have an expectancy or hope, not even really an expectancy, they just have a hope they'll get something. And I think many years ago, there's a bunch of case law as to whether trusts were actually property. And basically, if you look at the definition and I'm using the Ontario Family Law Act, so and assuming the definitions would be similar for other provincial family law acts. It's defined as any interest, present or future, vested or contingent in real or personal property, and includes A, property over which a spouse has alone or in conjunction with someone else, power of appointment exercisable in favor of that person, or property disposed of by a spouse, but over which the spouse has power to revoke the disposition. So if you read that and understand it, get a lawyer involved to understand it, A would tell you, yes, that's really where you get into trust interest having value, or sorry, not value, being property, and therefore are included on the financial statement of a separating spouse and needs to be valued. So, we'll talk about these different types of interests in a bit, because the type of interest and the construction of the trust itself will dictate whether it has value, or a particular interest has value, and how much. Okay, so we talked about discretionary versus non-discretionary, vested versus unvested, income interest versus capital. We already talked about that. So I guess one of the big picture questions on the value of a trust is who controls that trust. Okay, so we already know it has property. So if I have a discretionary income interest in a trust, that has to be disclosed on my financial statement. The next step is, how am I going to value that thing? I got to understand how to put that into numbers. So who controls the trust? That's a really important consideration, both in valuation and income. So there's a wonderful paper, and if anyone wants it, just send me an email. I've got permission by the author to distribute it. It's Blaney McMurtry, author, lawyer who practices in trust and estates, doesn't practice in family, but did this great little article about the issues of trusts in family and how they differ from trust and estate law. And there's been a lot of other papers on this issue as well. But one of the cases that she spoke about was this Supreme Court of Canada decision in Metro Vancouver Housing Court. Now, this was not a family law decision, but they looked at looking at whether the beneficiary could, like, these were their tenants. They looked at, can the beneficiary compel payments from the trust, right? So if it's discretionary, in theory, not. Non-discretionary, yes. Do they have the power to wind up the trust and then presumably get money out of the trust if they have a capital interest? And historically what's happened? Have they received regular payments from the trust, or only had this mere hope of receiving a distribution? The Dillon case, which was a family law case, looked at this issue of what mere hope was, and it actually brought in a marriage contract issue. So in the marriage contract, there was the husband put in, he had an interest in this Dillon family trust. A value is unknown, and he said, I'm a discretionary beneficiary. So the wife is challenging that marriage contract and trying to say marriage contract should be overturned because he didn't value it. said basically it could have been valued. She said it could have been valued, and therefore he should have disclosed it, and therefore the agreement should be set aside because he didn't value it. The judge, however, said that the interest in a discretionary trust can't be valued if the person is a beneficiary. His interest may be incapable of clear valuation since it is a mere hope. And so the judge sided with the husband and said the contract's fine. He disclosed it. He couldn't value it. There just wasn't a basis for valuing it. But you find, and again, not being a lawyer, my understanding is that the case law is a little bit inconsistent. There was another case here, Tremblay, relatively recent case. They kind of refined the Supreme Court of Canada factors down there, the ABC, and expanded them a little bit and said, look at, what was the founding intention of the trust? Was it ultimately to allow control by the beneficiary or fisheries? What's the composition and number of trustees? Is the beneficiary also a trustee? And if so, is it one of three? Is it one of one? What is it? Is the beneficiary part of the decision making? Do they have any veto powers? What's the history of the decision making by the trustee or group of board of trustees, whatever you want to call them, and the exercise of discretion? Do they have the ability to, does beneficiary have the ability to revoke the trust? And what's the relationship of the beneficiary to the trustees? Sometimes you look at the trustees and you see it's a lawyer, it's a family lawyer, or it's the accountant. Often there's family involved. So they also, this article actually said this too, it sounds easy, just go through these, understand the trust, understand the circumstances, and then go through these criteria. And then that's how you can start to determine whether there is a basis for valuation or not, if there's control. But the Herzovik case had something very interesting. He said, the judge said, it sounds easy, but the cost of doing this analysis is really high. In that case, it took, and it's funny, I was on a conference call with the valuation partner from KPMG who did the tracing in this case. And we were talking about this. Funny enough, that was just this morning. And in the decision, Herzovik decision, it said, it took KPMG 2 months full time for 2 people to do this tracing, because as they told me, it went back like 13 or 15 years to figure out what had gone in trust. And as a KPMG partner told me, it wasn't that it's rocket science. The problem was getting the documents going back that many years. I mean, I think they were having trouble finding documents from early on to try to substantiate what went on in the trust. Madronia, which is actually my case, funny enough. So I did the valuation in this case, and it was a trust. So the judge in this case looked at the roles of in the trust document. So in the trust document said that the wife was a discretionary beneficiary, and as was the husband. And I think, if I recall correctly, some of the businesses were too discretionary. The husband's businesses were also discretionary beneficiaries for some reason. But the husband had the sole power of appointing the trustee and beneficiary. So in other words, if you look through the document and look at the substance of it, that the husband could basically kick out the wife and ensure that all of the trust assets were distributed to him. So the judge in that case did, and I shouldn't take credit for it, I just did the scenarios that said, here's assuming that he has control, because we think he has control based on all these factors. And the judge agreed, saying that, he's got control. So I'm going to value his trust interest as equal to 100% of the value at separation date of what is in that trust. And she also talked about the wife's shares or interest in the trust, and said it was nominal because it's an adversarial interest. And in other words, the reality is the husband is never going to share anything in the trust with her. So put it at 0 at separation date. So one of the issues, of course, is first of all, who controls it? Because if there's an argument that I have a trust interest, but it's a mere hope, there might be an argument that's just it has a zero value. But if I if I do have some control, or if there has been a history of payments out, or some evidence that says there will be payments in the future, then there's probably a value to it. Now, the valuation of it, I mean, in Madronia was easy because it was determined that the husband had sole control. So we didn't have to get into, well, the kids are beneficiaries and the kids of the kids and other family members and blah, 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 blah. And how do we allocate the value? Because in this one, the assumption was husband's just going to be able to take it all for himself. So therefore, it all goes to him, both on the income side and on the valuation side. One of the issues, I guess, on the valuation is whether that trust interest was gifted or inherited and whether it should be excluded on that basis. So if you're looking at a client, if you're involved in the planning, that might be something to consider getting, like a deed of gift or something to be very clear that should be excluded. And of course, consider the trust interest was owned at the marriage date, because that means you've got two valuation date issues, which is good to get a credit for the marriage date value. And it's an important, I had a situation many years ago. It didn't go to court. I think it went to MEDAR, but I think it settled in the mediation. And it was actually kind of sad because both of the husband and the wife both had trust interests from the family. So they're both very well off, and they both have been basically given these trust interests from the parents. But what happened on the wife's side is she had it at the marriage date. So she got credit for it at the marriage date, but all the increase was shared. The husband, on the other hand, got his trust interest during the marriage, and it was set up as an exclusion very clearly. The professionals that he used were great. They made it very clear that this should be excluded. So he included nothing on his side. She had to include the interest, and it was a long marriage. So there's quite a bit of increase in value, which is sort of unfortunate because you think they both come in with trust interest. Why not just let them keep their trust interest? But they didn't have a marriage contract. And I think it was also the advisors for the wife did not anticipate something like this happening. So they probably didn't paper it as they might have had they known in hindsight there would be a separation. So sorry, we talked about the fair value or value to owner being the definition. So different ways to value potentially. If you've got a capital interest in the non-discretionary trust, then you're valuing a contingent interest and trying to say, okay, how much am I going to get? When am I going to get it? What's the value going to be when I get it? A whole bunch of factors, a lot of future looking stuff that valuators always get to deal with. If it is, if your discretionary interest or non-discretionary interest on the income side, then what's that? What's the history of that income? What's the underlying assets that generate the income? To try to value that. So then on the non-discretionary side, it's not any easier because you're still looking at a future expectation and guesses about what's happening. Now, in the discretionary trust, you probably still consider some of those factors, but then you get into all these other factors as to who has control, how can I actually get that money out? Because if I have a capital or an income interest in a non-discretionary trust, I know I'm going to get something sometime. I just don't know how much I'm going to get. I don't know when I'm going to get it. In the discretionary trust, you add the uncertainty that I may never get something because there's no guarantee. There isn't a lot of case law on how to value the trust interest, other than the ones I've sort of already talked about, which like Madronia was fairly straightforward because it was clear cut. It was clear cut who had control. But if there's a situation where there's more than one beneficiary, that may get into more complications. The Sagal case is the sort of leading case back, I don't know, I think it was the 90s, I'm not even sure, in Ontario. And I remember I spoke to one or both of the valuators that were involved in that case and gave evidence. And it was funny how they take it. Apparently there's no evidence brought forward about the value of the trust. And I suspect that's because the spouse who had the trust interest thought, well, it's discretionary, so I'm never going to get it. So we're going to use, arguments under basic trust law. But during the case, the judge determined it was property effectively and said, okay, now how are we going to value it? And there was no evidence brought about anything. The only evidence was, I think the evidence was, it may be worth X in total right now. And then the judge said, okay, how many beneficiaries are there? I think 9 or 7 or something like that. I don't know, 7 or 9. So the judge just said, well, I have nothing else before me. So I'm going to take the value of it, divide by 7. You're one of the 7 beneficiaries. You get 1/7 on your side. Now there are other cases, Van, we talked about Kushner, but there's not like a lot of cases on this. And I always wonder if that's because everyone's scared because they don't really know. There's so much uncertainty. They take it to court. They don't know what the result is going to be. So maybe it's better to settle it rather than testing it. One approach, it's funny, we talked about, and I've got this on I think there's a duplication on another slide, but the if and when. I think it's it. Yeah, so if and when down here in C. So in other words, saying, well, we don't really, it's really a non-valuation method. It's a way of avoiding the valuation and saying that neither of us know, maybe we don't want to go to court on this. So why don't we just say, whenever you get something, you have to split some percentage with the spouse. So as you could imagine, I think if that going to court, that probably wouldn't work because then you have to deal with enforcing. So so it might work in a case where the parties are friendly. I'm not sure how well it would work in most cases. Pro rata, we talked about, in historical analysis of distributions, relationship of the spouse to the trust, circumstances surrounding settlement of the trust. I think we talked about some of this already. Okay, one other point I'll bring up on trust is, I'm not sure if you guys have heard of the concept of, oh, Joanne has a question, but you're on mute, Joanne. Oh. Can't hear you. Can anyone else hear?
We had trouble with Joanne's mic earlier.
Okay.
Maybe she can.
Can you hear me now?
Yes.
Yeah, perfect.
Okay, good. You know what? I worked with earplugs and I think it changed the setting. Okay. With trust income, Melanie, that comes to the beneficiaries as taxable income, does it not?
Yes.
So when they're dealing with it, would that come into support per se versus an asset perspective?
Yeah, for sure. We're going to talk about that, but yes, for sure, it can come in. Assuming that there is some, yes.
If there's a distribution, of course. I mean,
if there's a distribution, exactly, because if it's a discretionary trust, then there may not be any distribution.
That's right. That's right. That's right. Okay.
So one other comment I'll make on the trust issue from the valuation perspective is this concept of constructive trusts, or what they're more affectionately called joint family enterprises in family law. So constructive trust was that concept that maybe I don't have an actual ownership, but the intention was for me to own something. So it's sort of it's not really a thing. It's not really an entity. It's really a remedy for the court to say, we're in good conscience. Oh, someone's in the way. In good conscience, so requires we can give someone an interest in a property that they don't actually have ownership of right now, and it's it's not an uncommon thing that someone will raise in, let's say, a cohabitation common law situation where you don't automatically have equalization rights to property, right? The Supreme Court of Canada shut the door a long time ago on that. But if, you know, I've seen it in many cases where the argument is that the one spouse that doesn't have ownership, the non-titled spouse, actually contributed to the business, helped build the business, whether, you know, they work there, they you know, pay, maybe even they were paid, but they contributed more than what they were paid, or as simple as a home that the common laws lived in. The one that doesn't have the ownership interest was there, you know, cleaning, renovating, spent money on it, whatever. So you can make that argument. It's not obviously a 50-50 split as you would get under an equalization, but you know, you see these weird splits sometimes that who knows how the court comes up with it, but it might be, who knows, be 20%, 10%, 50%, 75%, whatever. But you bring evidence to, and the court would decide how much interest you should have. So that's used to be called constructive trust, but we now more affectionately call them joint family enterprises.
Melanie, are you seeing, I mean, I'm seeing a lot more common law families that have 25 years together, never been married, 30 years. I mean, at that point, you know, how is when these, I mean, a lot of them great, you know, thankfully go through mediation or collaborative, which is much better, but
right.
Something like that hitting the courts, I mean, it's 30 years or, you know, this is a long common law relationship. Would the courts really look at unequal distribution at that point?
If there was a factual basis for it, an evidentiary basis, right? Because the starting point is on property, on common law, you kind of get what you get when you break up. You get what you get. So, and unless you can bring evidence to say I should get more constructively, or you know, I contributed to it, so it's unfair, or it was always promised to me, but never actually got around to changing the deed or whatever it is.
Wow. Okay.
Yeah, so there's a couple of cases on here. Let's see, Rathwell, you're looking to whether there's a causal connection between the contribution of the non-titled spouse to family life and the disputed assets. So basically, court looks at contribution of both parties. And this nice little, there's a quote there at the bottom from a 2018 case. The court will not allow any person unjustly to appropriate to himself the value earned by the labors of another. The facts must display an enrichment, a corresponding deprivation, and the absence of any juristic reason, such as a contract or disposition of law for the deprivation. So, okay, let me just see. I'm going to come back. About half. Yeah, I'll spend a little bit of time on these, but I'll definitely get to the trust side on the income piece as well. So one of the things on the disposition costs on trusts, and I see this all the time. So often trusts are set up, and the idea is, oh, we're a whole family. We've got 2 kids, 2 spouses. We can split that lifetime capital gains deduction. So let's say there's 4. You just decide to set up a trust for the 4 of you. So that means you can multiply that lifetime capital gains deduction by 4 times. And it's over 900,000 2022, as I'm sure you guys all know. So you can get close to $4 million. If I sell my business in 2022, I can get the first, or our family can get the first like 3.6 million tax-free. So who wouldn't do that? And that's great. I mean, that's the idea. Expand the pie of tax savings. That makes a lot of sense. Whether or not CRA would ever question it, if it was for a kid, but whatever, let's assume it's all good. But in my experience, the intention isn't that the child, with the 2 kids, are going to get their share of the proceeds on the sale, right? The idea is we're just going to suck out the kids' lifetime capital gains exemption. That's the idea. And we're going to effectively transfer that over to the parents. The idea of the trust is that if it's equal, then you're supposed to get both the proceeds and then the tax issues follow that. And I got a situation like that, two of them like this, where they set up those trusts, and the other valuator, I don't understand why, but the other valuator is saying, oh, I assume that even though, let's take the wife, for example, even though the wife is going to be written out of the trust, somehow the husband will end up getting some tax benefits of her lifetime capital gains exemption. I'm scratching my head. Well, why? Because she's out of the trust, you've got one less lifetime capital gains deduction. So why should you assume that he'll pay lower taxes that way? So anyway, I think yeah. In my view, you have to follow how the assets go and the tax. So if you're going to say that we're going to stick all the value of the trust onto the husband, let's say he's the one running the business, I'm just going to use he, then you can't say, well, you're going to be able to use the wife's lifetime capital gains exemption, so it's lower disposition costs for him. That to me seems patently unfair and unreasonable, but other people may have different views. Gifting, and so I've got a couple slides on here. Maybe I won't spend a lot of time on this, but just important, as I mentioned, to remember the gifting issues relating to gifting, and that if there is some planning going on the trusts, to ensure that there is some gifting covered, to get rid of some messy issues on separation. So deed of gift is always a good thing, even if obviously it's a gift because I'm freezing and giving a trust interest in the pref shares. So how can wife who's getting this from parents say that it's, how can anyone argue it's not a gift? But get a deed of gift and just have good documentation so it's not an issue later on. We talked about commingling already. Okay, so there's a case here, probably you guys are familiar with this, but the McNamee case went to Court of Appeal in Ontario in 2011, and it dealt with what is a gift. And it was a little bit of a scary, the initial decision was a little bit scary for tax planners, because it kind of, the lower court changed what everyone thought was the definition of a gift and the definition of a reorganization, and took what was a relatively sort of a standard type of reorg, and turned it into saying it wasn't a gift. But that was overturned. So the judge at that point said it wasn't a gift because father didn't give it gratuitously. It wasn't an intention to be a gift, but they were trying to preserve it from the spouses of the kids, and to preserve father's control. But the Court of Appeal said, no, the intention behind a gift doesn't have to be out of charity or affection. And the Court of Appeal reaffirmed the traditional definition of a gift, and that it's the intentional giving to someone else without expecting anything back. And the lower court had tried to argue, well, wait a sec, there was actually consideration because the son had worked 15 years and that was his reward. So it wasn't a gift. It was just delayed compensation. But the Court of Appeal did not agree to that.
Melanie, if it was considered delayed compensation, wouldn't that automatically mean that it would be part of the picture?
What do you mean part of the
part of a valuation? Because I mean, if it was delayed compensation, so to speak, it would have been earned during the lifetime of the marriage, right?
Right. Yeah, I think you get into really mind-bending issues there as to, well, wait a second, should he have higher income or not? But luckily the Court of Appeal said, no, those are silly arguments. And I think everybody was jumping up and down when that Court of Appeal decision came out because they were very concerned about it. Everyone was concerned about that decision. It's a bit of a rogue decision. Or so people thought. I heard from some lawyers. I'm just a lowly accountant. I don't know. So I think I've just summarized. Yeah, I've just summarized this just for reference. There is some, I've just got a slide here about conditions for a gift. So again, if and you know, whether you're getting a lawyer involved in a tax structuring, not a bad idea, but just making sure that something will comply with the tenets of a gift and that it's documented appropriately so that you don't have to worry about it when there's a separation. Okay, so I'm going to throw in, just before we get to the income piece of the trust, I just want to mention something that I find is a big issue, is the tax liabilities and contingent disposition costs. And I've seen this on a few cases where this gets into joint ownership, right, which is always problematic. So if there has been some funny business or some naughtiness going on during the marriage in the business, even though one spouse is maybe is an owner, is a shareholder, maybe is a director too, but not actually involved in the operations. In some ways, it doesn't really matter, because one of the arguments is, well, that spouse benefited from it. That's if that spouse is a director, any liabilities, whether it's tax or otherwise, accrue to directors. So if you're a director, you're stuck with it. So it's a very common issue. And people don't think about it. They think, oh yeah, well, we're getting the free trip, you know, a tax paid trip through the company this year. Woo! But you know, there's potentially some tax obligations. And I always tell my clients, I advise them do a voluntary disclosure. That's the clean way to do it. But you know, how many times do they actually do that? Not very often. It's not my decision, but I kind of inform them of what the issues are. And the problem with the voluntary disclosure, and I don't know if anyone's used this, it's no longer no names. So I had a case that went to court a few years ago, and it was an interesting case. But at that time, he did a voluntary disclosure. No, sorry, he said he was going to do a voluntary disclosure, but what the accountant did is a no names and said, okay, here is the situation. I have a client and blah, 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 blah. CRA, can you please tell me what you would do in this case? And interesting, in the court, in the decision, he said, you know, I'm actually going to do, you should let me take this tax liability, and it's not contingent because I am going to do a voluntary disclosure. I've done a no names, but I will do it. And the judge actually believed him, whereas that's unusual. A lot of people would say, well, yeah, sure, unless you did it, then why would anyone believe that? But now with the voluntary disclosure, you can't avail yourself of those benefits from the voluntary disclosure plan or program unless you disclose the names up front. And so it's obviously a bit, you have to think about it before doing it. And you can't contract those liabilities that accrue to both parties. You can't contract out of it. So I've one situation right now where the wife was a stay-at-home, benefited from all the shenanigans of the husband during marriage, and I'm sure she knew about it. And I'm sure she was quite fine with it. She didn't say, no, don't do that. I don't want the tax guy after me. But she's on the hook. So you can't then say in a separation agreement, well, you're going to take over all the liabilities, or why would the husband do that? Because she benefited from it. So it's really a challenge dealing with those issues. And I had a case where the husband did a voluntary disclosure and ended up, I mean, he could live with himself after, but much of his assets went to CRA, and he was quite happy. He said, I'd rather give them to CRA than my ex, because my ex caused all these issues. So fine, I'll give it to CRA. Not many people will say, I'd rather give it to that, especially when there's kids involved. Usually try to come up with something reasonable, and the hope is CRA is not going to question it, but they may one day. So there's a few cases I've got here about tax liabilities and whether the court allowed the tax liabilities. So Cosentino, for example, again, these are Ontario cases, so I apologize for anyone outside of Ontario. The court didn't allow the tax liability that arose from post-valuation date reassessment on what happened pre-valuation date. They just said no. In Calivas, which was the case, one of my cases, the court allowed this tax deduction from 8 years prior based on the husband's representation. He was going to go and do a no names, like voluntary disclosure after the court case was over, which I'm shocked at. And the judge is actually is an excellent judge. But he got it right because it turned out the husband did do a voluntary disclosure, which I was surprised he would do it, but apparently he did. If you think of, if you're taking on the shares, if you're buying a company, you're out, forget about Matrimonial. If you're actually buying a company, you're going to be doing a bunch of diligence to make sure that you're comfortable with the obligations that you're taking on, and getting reps and warranties. So, we could think of Matrimonial. That's an issue, obviously, as well. If you got a separation agreement, how do you know the spouse isn't going to call CRA and say, I'm out of it. My ex provided me with some reps and warranties, is going to cover everything. So now I'll just call them up and start an investigation. Okay, I'll skip that one. So contingent disposition costs, now not just tax liabilities, but can be tax liabilities, but can be other things. I won't spend a lot of time on this, but just a comment that this is an area that I've seen change quite a bit over the last few years in terms of people being more precise. There's some case law that basically said, someone wants in, a case that basically said years ago, if you have an asset that has tax attributes, and you put them on put that value on your financial statement, then it's only fair to also deduct the value of the tax, the disposition costs, whether it's tax or professional fees or whatever. So if you're selling a piece of real estate, you'd incur some brokerage commissions generally, incur some professional fees like legal fees. So, if I have a real estate property that is worth $2 million, why should my spouse get $1 million through equalization if when I sell it, I'm going to have to pay recapture capital gain and I might only net 1.5? So why shouldn't the spouse get 750 rather than $1 million? So that's a general concept. The principle is that the disposition costs have to be reasonably foreseeable. A case that someone was telling me about recently that we were peripherally involved, the other expert was arguing that no disposition cost should be allowed because there was a tax plan out there that would ensure that it was going to transfer the next generation. There'd be no taxes payable by this person. I thought, I'm not sure I like that argument. I'm not sure that makes sense. But the point of the disposition costs are being more refined. It used to be people would say, okay, well, if you sold assets, if you sold shares, immediately multiplied by 50, average it, multiplied by 50%, because we don't know when it's going to happen or how it's going to happen. So we'll just, but people we're doing this being way more refined to say, okay, how might this come out? What might the person's tax rate be at the time based on their other income and their other assets? And how are they going to take the money out? What's their life? They're not going to need it right away unless they sell the asset. That's in business. If they sell the asset, then obviously you have to pay taxes right away. No, sorry. If you sell shares, you'd have to pay the tax right away. If there is any above the lifetime capital gains deduction, if you get to keep it. If you sell assets, then there'll be a corporate tax, but you may take the money out over time rather than immediately paying yourself dividends. So lots of subjectivity there, but definitely valuators are becoming way more refined in how they do this analysis. So various, yeah, Segal is the leading case on that. There was a case, there was a couple of cases at one Canadian Rocky Mountain Properties. It wasn't a family law case, but it dealt with whether you should deduct disposition costs, and that was dependent on your expected hold period. Okay, so I've got a couple slides on the basics of income analysis that I won't spend any time on, but they're just there for your reference point. Other than what I do want to talk about is, we can talk about other things if you want to. Oh, pre-tax corporate attribution. Where are we here? So I don't know if you guys have seen this before, but this is always, this is one of the most interesting issues. When you have when you're looking at income for support purposes, you're looking at, is the person plugging a bunch of personal expenses through, and that's always fun because you have to be like the forensic accountant. The issue of attributing pre-tax corporate income, that's more of a bigger picture issue. It really, and there's a lot of case law out there that kind of gives some guidelines. Is when I started doing the attribution pre-tax corporate income years ago, when the guidelines first came out, I think most valuators were just saying, oh, attribution pre-tax, okay, we'll add 100% of pre-tax corporate income to the person's payers line 150 at that time. It's much more refined analysis now, and it's almost like a business analysis. So this concept is, look at what goes through a company, and it's not fair to let someone just have the company as a savings bank and not then have to pay support on those earnings. But you also have to be realistic. So you have to be realistic and say, maybe this year the company earned 200,000. But what does it need some of that 200,000? Does it need it to pay bills? Is there a banking agreement that says you can't pay out dividends, or you can only pay out so much of dividends, or you have to keep a certain debt equity ratio or working capital ratio? So lots of different things to consider, but it's almost like a business assessment. But you do get into some crazy, silly arguments sometimes. There's a lot of gray, but I've got one case right now where the other valuator said, yeah, this company's been making a lot of money, but they want to buy a building. So therefore, there shouldn't be any income attributed. I'm going, they can lease, or they can go to the bank and borrow. You don't have to keep all your earnings to buy a building. That seems patently unfair, because both the kids and the spouse are not going to benefit from the increase in that property going forward. So that argument to me is not logical, but others may not agree. Okay, so I've got a listing here of just some common considerations for attributing pre-tax corporate income. And as I said, that comes from, I forget which case it is, but it's been refined by other cases. Just here's some of the things to consider. And one, of course, is if the company had a loss, then then there's nothing to attribute. If the company had 200,000 of income, that's going to be, in the 1 year, that's generally considered to be your top end, assuming you've already accounted for any personal expenses, etc. And then you go down from there to say, okay, of that 200,000, what is reasonably prudent to have paid out? Doesn't mean the owner doesn't have to pay it out, but what could have been paid out? One of the key offsets, there's lots of possible offsets. One of them is who controls how that money comes out. So if there's more than one shareholder, then generally, well, often you might just stop there and say, well, wait a second, you got to get agreement. So that may be a non-starter. But if there's been distributions paid out through dividends or bonuses or whatever else, that's an offsetting argument to say, well, yeah, they obviously work together and they have paid out money in the past, so why wouldn't they do that in the future? So fairly judgmental analysis. Yeah, so there's a bunch of factors I'll let you go through just for bedtime reading. One of a bit of a bugaboo, and this isn't consistently applied. And many years ago, many years ago, I did a case and I gave evidence and on a case. And what had happened was my client was the wife, the husband owned the businesses, and we went and did an income analysis, and then time dragged on and they never went to court. And finally, they were going to court. So we had to update the income analysis, and the company lost money. So what I said is, well, wait a second. If you're attributing in previous years, I think you should deduct. That's only fair. And the lawyer that I was working on the same side as the lawyer was saying, no. Well, the child support guidelines say you can only attribute pre-tax corporate income. So it's a positive thing. So if you have a loss, you can't deduct it. I think that's unfair, but in general, that's what the courts generally say. And I've seen cases where they say, we don't agree. We don't think the wording of the child support guidelines is right, but that's what they say. So we have to follow it. I've gotten around that many times by saying, well, hold on. If this is a kind of a business that has rainy days, maybe COVID's a rainy day, major rainy day, then isn't it prudent business operations to say you got to keep some money in the kitty for when things like that happen? So if you attribute all of it or a lot of it, and then you end up with a loss, and you got to draw on capital, that doesn't make any sense. So why wouldn't you attribute less in earlier years? Okay, so trust distributions. So getting to trust. So section 19(1)(I) of the child support guidelines talk about the court may impute income where a spouse is a beneficiary under a trust and is or will be in receipt of income or other benefits from the trust. So again, we get back to that issue of control, the relationship among the trustees and the beneficiaries, history of payments from the trust, expectations of future cash flows. What's the source of the money going into the trust? Can the beneficiary get capital? Are they entitled to capital? Or has capital been paid out to the beneficiaries in the past? Is it discretionary, non-discretionary? What's the value of the underlying property? And is the beneficiary trying to divert income using the trust? So a lot of the similar types of analysis that you use on the valuation of a trust interest, you would also use in assessing whether any of the trust income should be attributed to a beneficiary. Okay, so I think we've talked about and I guess one of the other things you have to think about on a trust is if kids are getting are beneficiaries, or they've been getting, whether they're under 18 or above 18, but if they're getting or expected to be getting trust distributions, then whose distributions are those really? So you have to kind of really look into the distributions, who they've gone to, why they've gone to, what happens to those distributions. Gifts. So similar kind of concept, whether or not there should be imputation of gifts. And if there's a regular pattern of gifts that come in from parents or from anyone, then arguably that might be part of income, because income is a term that doesn't mean what we often think of, what's on the tax return. It can mean, for family law, it's something very different. And I saw this in a case. I love this case. I wish this case had gone to court. Not that I ever wish people going to court, but this would have been a great one to see what the court said about it. But what happened, it was a business that was owned by the father, started by the father. And the father was probably, I think at that time he was in his 80s. And he spent at least half of the year in Italy. And about maybe it was more than that, maybe about 6 years before separation of one of the sons, the father had basically done a typical freeze and transferred the common shares to the sons and kept the pref shares, and then had redeemed some of the pref shares. As soon as the separation happened, as soon as separation happened, the bonuses to the sons stopped, the dividends to the sons, everything stopped, and it all went to the father. So all of a sudden, you saw the father, who was getting money because he was redeeming his pref shares, started and was getting $36,000 a year as income. I wonder where that comes from. All of a sudden started getting $1 million a year. And that was what the sons were getting. And interesting in this case, we got access to the father's records, bank records. And what I found is that the money went, money went to the father on the bonuses and the dividends. And then the after-tax amount went out to the sons equally. So it was very, very clear cut on what was going on. They settled it, but to me, it's pretty obvious what would have happened. Some other imputation scenarios, we talked about that already. One other thing I want to mention about last few minutes is the shareholder loan accounts and how important it is to review those. And people don't always have the right impression of the shareholder loan accounts. Lawyers often think if things go through the shareholder loan account, that must mean that's evidence of personal expenses. But not infrequently, personal stuff is allocated to shareholder loans. So that's a really important thing to establish. What happens to those personal expenses? Are they allocated to the shareholder loan, or are they not? But of course, when someone overdraws, and this was not uncommon during COVID, where to survive and to pay, I think I mentioned, to pay the support orders, and a shareholder might have had no other way to get money but take it out of the company, or maybe did have another way but never thought about another way to do it, and took it out to make the regular support obligations. Well, then you get a debit in the shareholder loan account, and that creates some challenges from a perception point of view, from an attribution point of view, right? Because if someone overdraws a shareholder loan, it's a much easier argument to say, oh, well, that person the company doesn't need any money left in there, because look, there's evidence he just accesses it whenever he wants. But often I found the reality was they just, sometimes they just didn't have a choice. And, you have to factor in, and you have to factor in when that should come into income versus when it actually comes into income, how it's cleaned up by the accountants, make sure there's no double counting. So it sometimes becomes a bit of a self-fulfilling prophecy on the, if the interim support order is too high, especially, you got to be really careful. I had a client where the support order was, I don't know how they got there, but they got there, and it just is, it's very, very, very slippery slope. And then getting into including capital and income. That Cohabitation case dealt partly with that. Should you include in capital and income? So if you're, in other words, if you don't have a source of income in that year and you draw on your capital, either increasing your shareholder loan or pulling out of money from somewhere, should that be part of your income? That case basically said no, but obviously in some cases, possibly. Okay, I think the last thing I want to talk about is this scenario analysis, which I've sort of already talked about. But that's becoming a trend that's more common, as I mentioned, and it may be either because of different legal interpretations, or there's a shortage of or inadequate documentation, or it's unclear what actually is factual. So we have to make certain assumptions, and it's useful. I find it's useful for legal issues on valuation. Whenever we do disposition costs, for example, contingent disposition costs, we say, here's our assumptions. Now, if you find another set of assumptions is more appropriate, then we may need to recalculate it. Gifting or not, controlling the trust or not, different pre-tax corporate income percentages to be attributed, double dipping or not, right? Because we get the double dipping, which is a whole conversation on its own, isn't relevant for child support purposes, but it usually is for spousal support. So you might get a difference there on when you're looking at, is this double dipping for spousal or is it not? And we need to do different calculations for child and spousal. And we talked about the reasonability check. Okay, so I think that was, as you'll see, I've got a few more slides. I'll let you guys go through that if you want, but that's basically what I wanted to cover this afternoon. Any questions or anything?
I think the question will be, we need to call you when we get into some of these interesting situations.
Yeah. I mean, there's lots of interest. Some are nice and straightforward, of course, and that's great. But then you sometimes get into these challenges and things aren't clear cut. Oh, Joyce asked if you get a presentation. Yes, I don't know if Linda's sending them out.
Yeah, I will be.
Okay. And if you want that article, you've got my email address, or you can feel free to connect with me on LinkedIn and I can just send you that article. I've got others too, but that was a nice little summary article on the trust.
Yeah, that's great. I certainly think you've given us lots to think about and to realize how it's not very cut and dried.
Right. Sometimes it is. You always hope that sometimes.
I guess it depends on the case, right?
Right. Depends on the situation. Yeah, totally depends on the situation. And sometimes in reality, it depends on the numbers that are involved, right? If there's less to argue about, there may still be some issues, but why are you going to waste the money arguing about it?
Yeah, yeah, for sure. I think Joanne has a question.
Yeah, Mel, with respect to the gifting, what are you finding for the cases that do end up in court? I mean, are they still, very specifically looking for the, gift letter, how it was given? I mean, you always get into this, it, at least I'm sure you've come across it how many times. Oh yeah, no, it was given to me as a gift, and but there's no gift agreement. There's no, it was given to us as not a gift. It was given to us as a gift, but we have to repay it. Okay, and
that ain't a gift.
Yeah, that ain't a gift, right? Well, it was given to us, yeah, but we promised we'd repay it. Well, there's no loan agreement, there's no terms, there's nothing there. I mean, our courts looking at this going, listen, you got nothing here, nothing to back this up.
Yeah, I think, I mean, this is just my very limited, because a lot of times the legal side of it's going to be argued by lawyers, but
of course.
But what I saw years ago, it used to be a little more difficult to prove a gift unless you had a deed of gift. Yeah. I think now it's a little easier to prove it, but if you want to have, it's way better to have the documentation, and you might have to bring evidence from, people saying, here's what the intention was, and, be in the box and give evidence on that. In terms of the loans, I think once the intention is to I mean, you want to look at what that's a whole other set of discussion points is the validity of loans. And you think it should be easy because there's basic principles of law as to what's a loan or what's not a loan. But that's always an important issue, is looking at the substance of the loan, and whether it's, I'm sure you guys have seen it, is whether the loans are whether they pass the statute of limitations, right? So it's a bit of a different topic, but people are always shockingly claiming that as soon as there's separation, they owe back mom and dad, or one of the parents, for their mat home or whatever, even though mom and dad have never asked for, or maybe there was a couple of repayments, but interest hasn't been paid and they've stopped paying a long time ago. But then parents start an action, a small claims action or whatever action, to try to get judgment. There's a bunch of issues related to that because there's a statute of limitations, right? But that says if you don't start an action a certain period of time, and even though you haven't been paid, then you might not have any legal basis for it. for making a claim. So for parents or for anyone who loans money, get the documentation, even if you intend to forgive it even if you think one day I'll forgive it. Who cares? It's part of my
documentation.
Get the documentation, because if there's any separation and you may not get any credit for that. And it's a really hard thing to be able to get credit for it.
Okay.
Great. Well, thanks very much, Melanie. I think you've given us really lots to think about, and I think a lot of people will go through the presentation with a fine-tooth comb to see if there's anything that they missed in their notes. So thanks very much for spending the time with us.
My pleasure. Enjoy the rest of the day.
Thank you. So we've gone over a tiny bit, so we will reconvene at 4:30 to see our last presenter, Nicole.
Oh, Linda, do you mind if I stay for the next presenter? It sounded like an interesting topic.
Yeah, you're good to stay. No problem.
Excellent. Thank you.
Yeah, she's from BC, so it'll give a little different aspects too.
Yeah, that's great. Okay.
Okay, thanks.